Hey there, Brian, again from financenerd.net. I'm going to show you an interesting uh, process here to discover whether or not your retirement account or your whatever investment account you have is outperforming the market. So you should be competent if you've got a 401k at work or an investment account that somebody else is managing, some other financial advisor, and you need to be careful not to just look at the monthly return or the annual return compared to some other index or something and say, oh yeah, I'm doing better or I'm doing worse based on that average return or whatever it is, because you have to adjust your expectations for risk. And risk is always something that you have to pay attention to. So what we're going to do is look at the way the finance industry typically looks at this, and that's by generating or calculating the alpha and the beta. So these are statistics that are derived from a linear regression, and it's very simple statistics, very basic and easy to do in Excel if you have a little bit of knowledge about it. So what we're going to do is we're going to go through two scenarios to illustrate what this looks like, and we'll probably have to do this in two videos. But so what you need to do is you need to get data, and so I've made an assumption here. I've gone back for the last 24 months or something, going from June 2014 back to June of 2012. So I've got 25 months here, and you'll see what we do here. So I've got the S&P 500, the price or the index value of the S&P 500 during that period of time, and then I have this other range of values that I just randomly generated these numbers online, and so let's pretend like this is the value of my retirement account. So I started with $10,000, and it's gone up and down and fluctuated back and forth, and now we're at $14,000. So in 2 years, we're assuming that I've made a few $1,000s here. So the first thing you need to do is calculate your return on this rather than just the price level. And the way you do that is we'll just create another range of values here, and what we'll do is we'll highlight this range, and we're going to take the natural log of the change in value for all of these. Let's make sure we get our titles in here. So S&P 500 and my retirement account. So let's highlight this range of 24 values, and we'll say we use the ln function, which is the natural log, and we'll do the ending value divided by the previous value, so June compared to May. And when we do that, we hit Control Enter, and it shows us the natural log, or the change in value from 1 month to the next for 24 months there. So we'll format that into %, and then I'll just drag this over, and we have the returns for the S&P 500 and then returns for my hypothetical retirement account. So then we can look at some really simple statistics here. And so a few that are interesting would be the absolute return over that period of time, the standard deviation over that period of time, the average, or the mean, and the coefficient of variation. And I'll show you each of these and explain why these are important. So let's put the S&P here, and we'll put my returns here. Okay, so the absolute return for the S&P 500, we're just going to use the holding period return basically. So we'll go to the value that we're at right now minus where we started from, and then close the brackets, and then divided by where we started from. And that gives me a return of 44% roughly. And then we do the same thing for my account. So where we where we ended, minus where we started, divided by where we started. And so I specifically designed this to show you something important. It looks like my returns are better than the market. My absolute return from 2 years ago is about 46%, and the market's up 44% during that period of time. So we're going to see if I actually did better. Your financial advisor or somebody might show you this and say, look, we're doing really well. We're outperforming the market. Well, let's look at the standard deviation. We'll just use the standard deviation of the population for the S&P. And then we'll do the same thing for Brian. I always like to look at these in percentage values. So the standard deviation of the S&P 500 per month is only 2.25%, where mine, in this case, this hypothetical scenario, was 16.4, which is obviously kind of scary. So let's look at the average return per month, and we'll look at the average return per month for Brian. And that's obviously those are very similar, very close to the same number. So now we can use this coefficient of variation to kind of standardize this return. So let's look at the standard deviation divided by our average return, and help you interpret this. So essentially what we're saying here is, so for every unit of return, we get 1.5 units of variation with the S&P 500, or volatility. With my very volatile returns, for every unit of return, we get 10.5 units of volatility, which is obviously not good. So this is not looking good. On the surface, if you just look at absolute return, that's attractive. But when you adjust for the risk or the volatility, it's not looking so good. The next thing we would want to look at would be the linear regression. So to do this, we'll look at alpha and beta. So alpha is essentially the slope intercept of our regression line, and beta would be the slope. So alpha is the intercept on the y-axis, and beta would be the slope of the line. So there's some functions built right in to Excel. We'll call it intercept. And my known y's. So you have to understand the difference between your dependent and your independent variable. So right now, since we want to know how our portfolio did compared to the S&P 500, I'm going to set my portfolio as the dependent variable. Okay, so that's the y, comma, and then my x's are the independent variable, or the S&P 500. Make that in percentage terms. We usually talk about alpha in terms of percent, and then beta equals the slope of this line, and our x and y values stay the same. Okay, so 2.66, 2.7. Now, there's another way you can do this, and I want to show you a couple of different ways to do this, so that I always like to do it several ways, or use several different methods, and make sure that they remain consistent. That way you know if you've made a mistake. So in this other spreadsheet, I've got another formula here to show you how to do this using matrix algebra. So this is kind of the more eloquent way of doing a linear regression, generating a linear regression model. So what essentially we're going to do is we're going to implement this equation here. This for those of you not familiar with matrix algebra, this is the x variable times the x variable, and then we take the inverse of that product times the x variable, and then all times the y variable, and I'll show you how to do that with Excel. You're going to need to begin by highlighting the two variable cells, alpha and beta. So this equals m molt m inverse m molt, and then we take the transpose, and you'll notice we added this range of ones, and that just makes it so that our matrix algebra will work properly. Once again, do transpose of that. And then we do our y variable here, our dependent variable. And then when you do a matrix algebra or an array function like this, you have to do Control-Shift-Enter. And you'll see that if we copy the format over here, we get the same results. So it worked. We know that our alpha is negative 2.47% and our beta is 2.66. So that's interesting. One other way you can do this is by creating a scatter chart. So you can do insert, scatter, dots, and essentially what you've done is you've plotted the relationship between your x and y variables here. And one thing I like to do is go to layout and then trend line, more options, and display equation on chart. And what we've got here, if you drag that over to the white area, you can see we've got a slope of 2.66, which is the same, and we've got an intercept of negative 2.47%, which is consistent. So what that means is that when you plot this regression line, which is shown here, it has a negative intercept. It's below the x-axis, meaning that even though our absolute return was greater than the markets, the volatility for those returns made it less desirable than the market by a margin of 2.47%. So in this case, we underperformed. Even though our absolute return was better, we underperformed the market, and that's something you're going to want to be able to evaluate with your retirement account or your own investment performance. So there you go. Let me know if you have any questions, and in a minute I'll post the follow-up to this and show you an example where a lower absolute return than the market actually outperformed. So thanks for watching.